If you've been looking for ways to take advantage of the stock market when it's down, this video will give you some direction. Putting all your eggs in one basket is the last thing you want to do. I advise adding a few other products from various industries and areas to your portfolio to diversify it. You'll be able to determine what works and what doesn't for you so that you may adjust as necessary. I'll walk you through how you can invest in the stock market when it's down and make the most of your investment portfolio. Welcome back again to our channel. Today's video is about how to invest in the stock market when it's down. Before we start the video, please like, subscribe, and press the bell icon. Step 1. Talk to your advisor. Your advisor can help you create a plan which will help you diversify your portfolio and set up a plan of action for investing in the stock market. It's hard to know what to do with your money. That's why you need a financial advisor who can give you valuable insight into what you should do with your money to reach your financial goals. But they don't offer their advice for free. The typical advisor charges clients 1% of the assets that they manage. However, rates typically decrease the more money you invest with them. Step 2. Accept that the stock market will have negative years. The stock market is volatile, and that's normal. It's easy to think of the stock market as a high-stakes casino game where fortunes are won and lost instantly. This may be true, but it's also misleading. The fact is that there have been plenty of times when the stock market had negative years, and even decades, over its history and many more periods where it was positive for long stretches at a time. The critical thing to remember about investing isn't just that you can make money if you pick the right stocks at the right time. It's that even when things go wrong, you're still taking part in one of humanity's most significant endeavors, investing your hard-earned money to improve your family's prospects for generations to come. So don't fret when the stock market makes a hostile move. Just keep going. Step 3. Rebalance. If you have a target allocation that's not being met, it's time to rebalance. First, look at your portfolio allocation in percentages and see if it needs adjustment. If the shares are close to what they were initially, it might be best not to change anything. If anything, consider adjusting how much each investment type is represented in your portfolio versus each investment account. If your original allocation, say 70% stocks and 30% bonds, has shifted significantly over time due to market conditions or other factors, say 60% stocks and 40% bonds, then now would be an ideal time to rebalance back toward the original target allocation by selling off some of those more volatile investments and reinvesting in less risky ones. Step 4. Take advantage of dollar-cost averaging. Dollar-cost averaging is a way to buy a fixed dollar amount of a particular investment on a regular schedule, no matter the share price. It's an excellent way to invest, mainly when the market is volatile or you don't know when or if it will rebound. When you sign up for dollar-cost averaging, your brokerage automatically invests money from your account into the same investment on a regular schedule, for example, once or twice a quarter. You set how much money should be invested, called the investment amount or dollar size. If you want to keep buying more shares at lower prices as they become available throughout time, then increase this number accordingly. Step 5. Diversify your portfolio. When the stock market is down, you may be tempted to panic and sell all of your investments. But this is not a good idea. It's better to diversify your portfolio. Why? Because diversification reduces risk by spreading it across several different types of assets. Instead of investing all your money in just one kind of investment, like stocks, you can also invest some of it in other assets like bonds or real estate. The greater the diversity among these investments, the less risky they are as a whole. The best way to diversify is by investing in multiple asset classes, for example, stocks and bonds, and then again within each asset class by purchasing different mutual funds or exchange-traded funds ETF. Step 6. Only invest what you can afford to lose. Investing is one of the best ways to build wealth, but it's also a high-risk venture. Not only can you lose money, but you can also lose sleep. If you're new to investing and don't have much experience, start small and invest only what you can afford to lose. If something goes wrong and you lose your job or something unexpected happens, like your car breaking down, it's good to know that there is a safety net underneath you. The last thing anyone wants is to be homeless because they were investing everything they had into something that didn't work out as expected. Step 7. Look for opportunities. As a value investor, you look for companies with low stock prices relative to their earnings or book value. If you're investing in a growth company, the value of your investment will probably increase over time as it grows into its valuation. You'll want to avoid companies facing problems or having too much debt. A company's financials should also be transparent to see how they performed in the past and predict how it'll perform in the future. There are ways to take advantage of the current market situation. If you're interested in investing in the stock market, there are a few ways to do so. You can buy stocks directly from a company. Companies will often offer their shares for sale directly to the public, which means that you can purchase them as well if you wish. This is referred to as a direct investment. You can also buy shares of mutual funds through brokers and other financial professionals who act on behalf of investors like yourself. This is called indirect investing because one party, the investor, gets involved only after another party, the broker, has made the investment decision on their behalf and purchased those shares on their behalf through some sort of intermediary vehicle like an exchange-traded fund ETF. Step 8. Maximize your retirement investment. The best way to invest in the stock market when it's down is to ensure you are maximizing your retirement investment. It's never too late to start contributing, but starting now will give you many years for compound growth of your money and help you reach your financial goals. Make sure you're taking full advantage of employer matching contributions and other tax advantages by contributing enough money each year so that all available matching funds are used up before the end of the tax year. If possible, try not to withdraw any funds from this account until after age 59 and a half. This is when most early withdrawal penalties go away. Finally, there will always be a time when the market is down, so you should take advantage of it by giving yourself opportunities to invest and having an advisor you trust. It's essential for retirees because it allows them to expand their portfolios and get more investment returns. While taking advantage of this situation may seem risky at first glance, several things can be done to ensure success, like diversifying your portfolio or reallocating the funds from other investment vehicles into equities. And if you think carefully about how much money you want to invest into stocks, then we guarantee we'll find success. That's all for now. Thanks for watching the video. If you enjoyed it, please comment, like, share, and subscribe to our channel for more exciting content.